Is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thank you for joining us for today's free webinar, When is it time to hire a CFO? With Cirque Rowe from Early Growth Financial Services. My name is Gina Longmire, Marketing Manager for Early Growth Financial Services, and I'll be your moderator today. This presentation will run about 40 minutes. If you have any questions as we go along, please feel free to type them into the question field, and we'll get to them as they come. If we can't get to them, we will make sure to get to them at the end of the presentation. We'll also be sending out a deck with this we'll also be emailing out a link to this deck and presentation tomorrow, along with a recording, as well as your presenter's information should you have follow-up questions. Today, our presenter is Cirque Rowe. In addition to being an amazing man and a fantastic golfer, Cirque is the Chief Operating Officer for Early Growth Financial Services. Cirque has 25 plus years of financial experience with 17 years serving in financial leadership roles with high-tech companies. He's an accomplished finance executive focused on leading early-stage companies through strategic financial decisions. Before we get started with this presentation, Cirque, could you say a few words about Early Growth Financial Services?
Sure, absolutely. Thank you very much, Gina, and good afternoon, everyone. We appreciate you taking time to spend a little bit of time with us to go through this presentation. Before we get started, just a little bit about early growth, and we'll be kind of touching upon some of the services that we provide and how it might help companies such as yourselves if you're listening to this presentation. But we are an outsourced accounting and financial services firm. And we work with the small and medium-sized businesses here in the Bay Area. That typically means tech startups, but we do work kind of across all industries for basically companies that don't have the need or are not yet in a position to be hiring people full-time. We offer these services on a pay-as-you-go, grow-as-you-grow basis. So we provide basically four types of services. We do corporate tax returns. We do company valuations. So for example, if you are a company that provides stock options to your employees, you have to be doing a valuation of the stock option exercise price on an annual basis. We provide that service. And both of those we do on a per project, typically once a year basis. And then in addition to that, we provide consulting services. And for consulting services, we do basically two things. We do accounting and bookkeeping work. So this is the day-to-day, week-to-week, and month-to-month accounting that your firm is going to want to have, including a full, hard monthly close of your financials. And to us, what that means, it's GAAP compliant, accrual based. We do full balance sheet account reconciliation so that anyone who's looking at these financial statements see what's going in and out of the balance sheet on a monthly basis, and where you really, really get the confidence that the financial statements truly reflect the financial condition of the company at that point in time. And finally, we provide CFO level services, and for that is typically a review of those monthly financials to make sure that they're accurate. We are firm believers in doing having two sets of eyes look at work product before going out to clients and to investors and bankers and whoever else may be looking at these financials. And then we also provide consultative services for other types of things that you might want to have someone at a high level in a high level financial role looking at, whether they're budgets or helping with fundraising or taking on debt, a long-term planning, long-term financial planning, basically anything that you would typically go to a CFO for, but if you're not in a position and if you're not big enough yet, and it doesn't make sense for you to be hiring someone internally, then we can provide those services on an hourly basis. Some of our clients literally use us for 1 to 2 hours a month just to do a touch-in to make sure that they're on the right path or to discuss any specific issues that are going on. But those are our services. And we are a national firm. We started here in the Bay Area. We also have a pretty big presence in Southern California and Los Angeles, and we also have offices in New York, Chicago, Seattle, Washington, Boulder, Colorado, Austin, Texas, and Las Vegas, Nevada.
Awesome. That was an amazing introduction. And so now let's get started and jump right into the presentation so Cirque can explain what the startup CFO actually does, when you think you should think about hiring one, and your options for filling this role. So Cirque, I'll turn it over to you.
Fantastic. Okay, so this is basically what we're going to be covering. We're going to talk about kind of what CFOs do, and there is, obviously CFO is first and foremost a financial person, but we'll talk about the fact that a CFO should be more than that. We'll talk about some of the other things that CFOs do and where they should be adding value in addition to financial and accounting systems and numbers. We'll talk about how CFOs can help drive a company's growth, whether it's in terms of revenue, whether it's in terms of helping the company plan for growth internally. So, looking at hiring plans and looking at, real estate plans or office space plans, looking at obviously fundraising, to support the growth of the company, looking at bank debt versus other types of debt versus equity. Those are all things that CFOs can and should be doing to assist in a company's growth. We'll talk about when to engage or when you want to be hiring a CFO, when it makes sense to do so, when it makes sense to not do so. And finally, we'll talk a little bit about outsource versus in-house CFOs, the differences, what you can and should be expecting, how you can make that relationship in both cases work well for you as a founder or an executive of a firm. And as Gina mentioned, anytime along the way, if you feel like we're touching upon a topic where you have some specific questions, feel free to just fire them off to Gina, and then she'll present them, and we can discuss questions that come up that will be good for the entire group. But moving on, so what does a CFO do? And here's a whole bunch of bullet points, right? There's a lot of the stuff that typically CFOs do, and we can touch upon it, but I don't like to read bullet points here. But it's a lot of this stuff is financial. Yes.
Sorry, I don't mean to interrupt you. I realized I forgot to mention in the beginning, along with asking questions in the question field, should you have any, please feel free to type them in. We'll get to them. But you can also tweet them to us at #HireCFO at Early Growth FS. So you can either tweet them to us or ask them in the question field. I apologize. I forgot to mention that in the beginning.
No worries. Yeah, thank you, Gina. And so, you can see these bullet points, and so we'll touch upon several of them, but it's about all the financial stuff, right? It's about, making sure financials are accurate, making sure that projections are in place so that everyone kind of knows, what to expect going forward. Obviously always looking at cash, especially for startups where cash is king. Always having a handle on cash, where it's at, where it's gone, and where it's going, and to be helping the company manage, towards all the things that it needs to be doing with the cash that they have and with the cash that they're expecting to raise, either through revenue or through external resources. You're looking at, putting together long-term plans, and you're putting together, monthly management reports, and they may be KPIs or key performance indicators, or they may be financial, or they may be revenue based, or they may be customer based. But really, the CFO is the person who can put together kind of those key metrics that companies should be looking at and managing towards, and he or she can and should be the gatekeeper of that information so that everyone's on the same page. Obviously, things like pricing, CFOs are involved with, as well as the sales and business development team and the other executives. Debt and looking at mergers and acquisitions, and like I said, in terms of equity and debt, bringing in external financing and the negotiations and bringing in the right players to help with those, to get the best terms for the company. Those are obviously key things that CFOs can be doing. But in addition to that, what I really like to say about what a CFO really does is, I just think of the CFO as kind of being, whether you want to call it the consigliere of a CEO or a do-it-all executive, someone who's kind of the gatekeeper and kind of manager of all things and all departments, and making sure that everyone is really striving towards the same goals. A lot of the times you get a CEO or a founder of a company, and especially at early stages, who, they probably have a specific strength. They may be a technical person, and so they're starting a company to develop a technical solution. They may be kind of like a sales and marketing person, or they may be an operations person. But typically, a CEO or a founder of a company doesn't have all the necessary skills and expertises and experiences to actually help drive a company forward in all respects. So they may be great at product development, or they may be great at messaging the company's value propositions to customers, and signing up customers. But when it comes to some of the internal planning and some of the setting up processes and policies, they may not be the best. In most cases, they're probably not the best. And so CFOs should be doing that. CFOs, as far as I'm concerned, most CFOs I know, handle, things like HR or human resources for early stage companies. Again, before, a company is big enough to actually have an HR department, for example. CFOs work with legal teams, so they're involved in the contract negotiations and reviewing of contracts before they're sent out to partners and to customers and to vendors and whoever else that we're getting into contractual agreements with. They're risk managers, right? So CFO is a risk manager. So in addition to, in addition to helping a company grow, they're the ones who are, watching out and making sure that we're managing risk. So it's looking at, okay, well, what are some of the potential areas of liability for our company, and how do we limit that? What kind of insurance do we need to be putting in? Is it sufficient for what we're trying to do, both with clients and with vendors and with investors and directors and officers and the work that they do? So all those things are things that a CFO does, which ultimately what a CFO really should be doing, if you look at it at a 10,000-foot level, is he should be he should be giving peace of mind to the CEO or the founder, that all of this other kind of stuff that is being taken care of by someone who knows what they're doing.
So, Cirque, it sounds like the CFO has a lot of responsibilities. There's a lot he has to do.
A lot of
He or she, yeah.
responsibilities.
So then could
Yeah,
you kind of
absolutely.
no, definitely. And then, so maybe could you touch upon if these startups were to be hiring a CFO, maybe kind of some of the qualities or skills they should look for in that CFO, someone who could, what should they be honing in on so they could cover all aspects of the responsibility?
Absolutely, absolutely. That's a great question. And actually, before I touch upon that, Gina, let me just go back onto one bullet point here that may be near and dear to a lot of the listeners' hearts, and that's the point number 2, which is investor introductions and relations. So, again, if you're a tech startup and if you have the kind of company that is going to go through hyper growth, and you need external financing, so we're talking about equity financing from VCs or angel investors or other investors like that. That goes beyond kind of the founders, putting in money or getting a little bit of friends and family money. Then a CFO, the right CFO, should be able to introduce, CEOs to investors. In that space. So most CFOs, especially CFOs with tech experience or in the high tech space, should have a Rolodex of investors that they have worked with in the past, who they know. They should have a good idea of, who invests in what kind of companies, and should, and one of the things that I think a CEO should be asking of a CFO candidate is, what's your Rolodex like when it comes to things like investors? So that's a key one. But to your question, Gina, or to a listener's question about, what are the qualities you're looking for? Like I said, I think you're looking for someone who's experienced, someone who kind of understands your space, and not necessarily that someone who has worked for a competitor of yours, or who's worked, it really, really directly and comes in, day number 1, really, really understanding your model. That's not completely necessary. It's obviously helpful, all things being equal, it's helpful, but I don't think that that's really the key success factor. I think the key success factor is, to be honest with you, I think that the most important thing that you're looking for is, okay, think about, the growth over the next 2 to 3 to 5 years of the company. Think about where you expect it to go. Are you going to be selling domestically? Are you going to be selling internationally? What's your business model like? Are you selling a product? Do you have to worry about things like inventory and manufacturing, or contract manufacturing, or or are you more of a software company or a SaaS business? The type of business that you have will kind of determine the activities that you're going to be undergoing and the types of other companies that you're going to be dealing with, and working with a CFO who understands the type of work that you're going to be doing and the kind of growth and the kind of activities you're going to be undertaking over the next 2 to 5 years is really, really important. One thing that I think probably doesn't get highlighted enough, in my estimation, is I personally think that the key thing that you have to look for is fit. And we use that term loosely a lot. A lot of people talk about fit. A lot of people talk about, I'm not so sure about their technical skills, but their fit was good, or they really have great technical skills, but I'm not so sure that the fit was there. Well, I can tell you, if you're a CEO of a company, that relationship that you have with a CFO of a company has to be tight. It has to be one where you can go to the CFO and really, really bare your soul. The CFO should be, should be your priest. Like I said, I used the word consigliere before, right? That is the best term to use. I mean, if you're a godfather, you need to have your right-hand man, the guy that you can go to, that you can go to with any kind of problems, right? They may be dirty. It may be dirty laundry. It may be something that's not fun to do. It may be, talking about, hey, look, we're making a pivot in the company. We might have to let some employees go. The first person that you should be that you should be thinking about talking to should be the CFO. And so that's the kind of relationship that you want to have. And so to have that relationship, to me, the fit, the personality, the communication style, the way that you look at business, that all has to fit. And that's not to say that they have to think exactly like you. And in fact, I think that some of the best relationships between a CEO and a CFO are where there are very, very big differences. So the CEO may be the high-flying risk taker, and he or she may know that, and he or she may decide, hey, you know what? As much of a risk taker as I am, I need someone more grounded. I need someone more conservative as my CFO. And I think that's a great, great relationship. But someone that you can talk to, someone where you can say, hey, listen, Mr. CFO, I'm thinking about doing such and such and such. I know it's going to take a pretty big investment. What do you think about that from a risk profile or a return profile? How do we model something like that out? And to really talk things through so that you get two sides to the argument about next steps that you should be taking. That's a key one. Obviously, you want someone who's technically sound, right? You want someone who is going to be able to, who's accurate with their numbers, who can think through logically and systematically about the assumptions that are really driving the business. You need someone who's going to be able to model things out. You need someone who's going to be able to make introductions to investors. You need someone who who you trust for hiring, for example. So when I'm a CFO for client companies, typically I get brought on to actually help with the hiring process. I interview candidates, even when I'm working with them on a contract basis, because the client trusts my judgment and my ability and my experience in hiring people to kind of bring that towards to the decision-making table. So those are some of the things that you really, really want to be thinking about as you hire a CFO. It's not just a numbers person. You need someone experienced in doing all of these things. For example, if you are a startup and you've got 3 employees and you're looking to add 4 or 5 more employees over the next year, that takes a different skill set in terms of a CFO than someone so for example, you may think, boy, this would, I've got a candidate who's kind of worked at a larger company. company, and boy, it would be great to have someone like that on board. And yet, that person may not be the best fit for you at this point in time. You may need someone who's really, really kind of dug up and rolled up their sleeves and dug their hands in and really got down and dirty, helping a company grow at this early stage, and that might be a better fit for you. Someone who's had to scrounge around and bootstrap and figure out, how do I maximize cash? How do I work with my vendors, and how do I work with my customers? And how do I get a little bit of extra cash from a bank in terms of a credit line? I mean, those are things that if a CFO is doing a good job for you on that front, it can really, really help you, especially initially during your early stages of growth.
Thank you. That was an awesome
This is
explanation.
just this slide is obviously just a financial slide. We just use it to kind of highlight that, at an absolute minimum, CFO needs to get numbers right, right? And it's numbers right in terms of, okay, here's a P&L, a high-level P&L. We need to understand what sales are and where it's coming from. Who are our customers, and what price point are they buying? What price point are they not buying? Where do we see growth? How do we plan that out? What does it actually cost, and what does it take to actually acquire a customer? And understanding those things. The cost of goods sold, right? So all the costs that are associated with producing that revenue, and it just may be the cost of the material that goes into building a product. It may be obviously the services required to deliver a SaaS based product, for example. Whatever the margin or the cost of goods is, we obviously need to understand that, because that's really going to drive kind of our gross margin analysis, which is kind of the first thing that you want to look at. Revenue and gross margin are the first things you need to look at in terms of what the potential of the business is going to look like. And being able to classify those costs correctly is an important one. We see mistakes all the time where people are misclassifying, certain types of expenses, for example, or we see companies who are doing, for example, a revenue share model, right, where a dollar of revenue gets shared by 2 or 3 parties, and you have to make a determination. Well, who gets that $1 of revenue? Do I get that $1 of revenue and then assign the 67 cents to the other partners as cost of goods, or am I really just a secondary party and I'm only getting the 33 cents out of that dollar, and I can only be reporting that 33 cents as revenue as opposed to the entire dollar? Questions like that are really, really critical to get right, because otherwise you're misrepresenting the results and the potential of your company. And obviously looking at things like total costs and the operating expenses, making sure that those are being captured properly, making sure that they're on an accrual basis, so that you are matching up the expenses during the time that they were incurred, as opposed to when you actually spent the money. That's really, really important, because otherwise you can manipulate numbers to make it look very, very different than what the actuality is. And another mistake that we see companies make when we first start working with them is they're so worried about cash that they do their accounting on a cash basis. And I think up to a certain point that makes sense, and in some cases I think it's even more it makes even more sense than doing accrual-based accounting. But if you really, really, really want to report the results, the financial results of a company over a period of time, you really need to be looking at when the expenses were incurred and when the revenue was recognized, and not necessarily when the cash was received. Okay, so these are some of the things that some companies or some clients don't think about as to how CFOs can help drive startup growth. So a lot of clients and a lot of companies see CFOs as kind of being that watchdog, right? The one who's doing the counting of the financials, and he or she is not necessarily going to help me grow the company, but I do need him. It's kind of like a necessary evil type of thing, right? We need to do it. We understand we need to do it, but I'm not so sure that he or she's going to really help me grow the company. and that's I just think that is I think that's a short-sighted view of what a CFO can do. I think a good CFO should be able to do some of these things. So understanding the market opportunity, helping a client or helping a CEO really understand the opportunities today, versus tomorrow versus a year from now. So we look at things like, and CEOs should be looking at things like, TAM, which is the total available market. Okay, let's funnel that down to a SAM, which is a serviceable available market, and then a SOM, which is a serviceable obtainable market, right? And so you start with, if you put together a plan that says I'm going to take over the world on day one, that's obviously not feasible. What are the niches that we want to go after? Does it make sense? Are the dollars that we're investing in one particular niche, does it make more sense over another? A CFO can absolutely help drive that decision making, ask the right questions, making sure that we're thinking about things from a strategic standpoint as well as a tactical standpoint, and what does it really take for us to be successful in that niche. Looking, like I said, long-term thinking, right, is a key one, because, a lot of times we really get focused and bogged down in the day-to-day details and what do we have to do today, what do we have to do tomorrow, and if we're not successful in doing things over the next month, we're not going to be successful. And a CFO, what he or she is thinking about is, okay, I know others are thinking about what has to happen today, what has to happen tomorrow. I'm going to be thinking about what do we need to do to be successful long term. Where is this business going to take us a year from now, 2 years from now, 5 years from now? What do we need to implement today, or what do we need to start thinking about today to enable us to get there? So it's things like okay, always looking at your cash and always determining when does it make sense for us to start fundraising. Because I tell you, if you're in fundraising mode, that's all you're doing. And it's hard to focus on kind of day-to-day events or activities, and even some of the customer-related stuff. It's hard to focus on it because as a CEO or as a founder, you're going to be fundraising. You're going to be in fundraising mode, and that's going to take up a lot of bandwidth. Having a CFO kind of walk through, okay, this is the timing. We've got 9 months of cash left. We need to start the process of putting together a financial plan. We need to put together a pitch deck. We need to put together an executive summary. CFOs, most CFOs, especially ones that have worked in startups, know what investors are looking for and can help put together that pitch deck and that executive summary, making the introductions, helping through that process so that a CEO can focus on the things that he or she needs to focus on in both aspects, the running of the company as well as the fundraising efforts and what they have to do. Having a partner who's been through that and can help you navigate through that is really is a great peace of mind. And I think for most CEOs who have worked with great CFOs, they'll tell you that that they couldn't have done it without them. Identifying strategic partnerships and doing some internal things like effectiveness of management or effectiveness of policies or effectiveness of programs. CFO is actually the first person who should be asking the question, hey, we just ran an email campaign, or we just ran a marketing campaign, or we just ran an advertising campaign. This was we made this decision to do that based upon these assumptions. Now let's go back and let's see how effective it was. Did we meet our goals? If we didn't meet our goals, what was the problem? Is it just a bad campaign? Do we need to use other partners? Do we need to change how the campaign worked or looked, or do we need to change the target market? Someone who's looking at the numbers and who's really being logical and using numbers to help make those determinations can help put things into explicit format, as opposed to, well, I think that was successful, or I think we got what we need out of it. Your dollars and your time is too valuable to to not know these answers, and the CFO can help you do that. Again, the employees getting, understanding when we need to hire and who we need to hire, at what point, at what level, and at what time. those are critical things that are going to make or break a company in most cases. If you are in growth mode, hiring the people at the right time, and when I say at the right time, I mean not too early and not too late, because both are can be critical mistakes that will either slow you down or can even break you. And again, a good CFO has been through this many times before, has helped in hyper growth modes, has helped with hiring, over time, and can help, with that decision making. And we've already kind of touched upon the whole, fundraising support and introductions to VCs. Obviously, if a CFO can help you raise and secure and close on a multi-million-dollar financing, well, you know what the value of that that CFO is without me having to go into it.
Cirque, that brings up a quick question, and it says, okay, so let's say you've realized that you do need a CFO. What are your options in terms of filling this role? Also, what other financial responsibilities do you need to consider? When does the quote unquote flag go up that it's time for your company to hire CFO services? And what qualifies as real revenue? Can you give an estimate or a range?
Sure. Thanks for that. Actually, let's go to the next slide because that answers this will actually answer probably one or two of those sub questions, and that's kind of like, when should you engage with a CFO, or when should you engage with a financial services firm, or someone in financial services at a high level. And there's these are some guidelines, right? I mean, if you've raised some significant amount of money, and you need to be managing that cash, and you need to be putting together projections, revenue projections and spending projections and cash flow projections, obviously that's a key time. When your company starts generating real revenue, and there's multiple reasons for that, because at this point now you probably have several things going on, right? You may have contracts, right? You may be signing contracts, or you may be going through some revenue recognition issues. So I highlighted that one case where you got revenue sharing, and how do we account, or how do we know that we're accounting for things properly? How do we know we're counting revenue properly? If you sign a contract, if a customer signs a contract with us that says, hey, I'll pay you $1,200 for 12 months of service, I've seen companies recognize $1,200 of revenue as soon as they sign that contract, or as soon as they receive that cash, and that's absolutely incorrect. You need to be recognizing that $1,200 over the period of the contract. So instead of $1,200 in month one, it's $100 per month over 12 months, and so things like that, obviously. So as you start generating revenue, that's a key one. If you have institutional investors, and when I say institutional investors, I'm talking about VCs, venture capitalists, then you will absolutely need a CFO, because now VCs have certain expectations. They have expectations of financial reporting being done correctly. They have expectations of budgets and financial plans being done and tracked. They want to see waterfall charts, so they want to see things like, okay, here's your, here was your budget for the year. On a monthly basis, how is this budget changing into a forecast? How is it changing over time? Are we slow in our hiring? Is our revenue ramp as quickly as high and as fast as expected? If not, what are we doing about it? Are we managing to cash? Are we managing to revenue? What are we managing towards? And having someone understanding what the investors are expecting in terms of reporting and financial planning is critical. And most CEOs, especially first-time CEOs, are not fully, they don't fully understand the rigors involved in this kind of reporting and this kind of relationship management with institutional investors. Obviously, if you have a lot of complexity in your model, and if you have a lot of activity in your company, the more activity you have, and the more complex the business is, obviously there's a greater risk that things are kind of falling through the cracks, or things aren't being recorded properly, or things aren't being reported properly. And in each of those situations, you want to be very, very careful, because again, the one thing that you need to have as the CEO, and the one thing that you need to be able to produce to outside, whether it's investors or bankers or other partners, partners is you need to feel confident that the financial statements and the financial projections and the cash flow projections, forward plans, everything that you're putting together are as accurate as can be. And in my estimation, the CFO is the best person to put that stuff together. And they're not the ones who are actually coming up with the plans. Obviously, it's the CEO or the founder and other executive team members. But in terms of actually reporting it correctly, capturing the expenses and the revenue properly and in the right time periods, updating forecasts as we know things are changing from our original budget or our initial plan. Those are things that a CFO can and should be doing. Did that answer all your questions, Gina, or were there a couple of sub bullet points in that question that I didn't get to?
No, I think you covered everything. That was perfect. Thank you. You were great.
Okay, fantastic. Okay, so the next slide then is just these are the options, right? And so these are some of the things that you can do and some of the things that you need to be doing. So, let's start at the bottom. Obviously, you're going to be doing tax returns on an annual basis. And you may be doing, if you're making money, you need to be doing estimated tax payments. You need to stay on top of these, what I would call compliance issues. In addition to tax, there's going to be things like, like registrations and keeping current with your registrations, in the locations that you have nexus, and so the compliance issues are things where, let's face it, we hate this stuff, right? CEOs hate this stuff. It's a necessary evil, unfortunately, and obviously a CFO can assist in that. But at an absolute minimum, you need a firm who's going to help you with your tax returns. This is not something that you're going to do internally. Likewise, again, if you are doing any type of transactions involving stock options or transactions where understanding the valuation of your company is important, you need to have the firm valued by an external party. So having a valuation firm, at some point is a requirement. It's not a nice to have. It's going to be a requirement. So keep that in mind. And so and obviously some of the services like the bookkeeping, the month-to-month bookkeeping, day-to-day bookkeeping. You may have an office manager who's knowledgeable enough about bookkeeping to be able to kind of keep things going. And for a while that will probably be sufficient. But at some point it's going to get too complex. You're going to start losing confidence that the financial statements and the recording of activity is not accurate, and so you're going to want to bring someone in who is an expert at that, and not just an office manager who's doing a little bit of bookkeeping on the side. So and obviously we've talked about kind of the higher level CFO type of stuff, and all that is important. Now I will say that some CEOs are already pretty knowledgeable about this kind of thing. They may have some experience already. A lot of CEOs I know come from investment banking, and they're very, very knowledgeable and savvy about financials. And obviously if that's the case, then you could probably go a little bit longer or further down the path without hiring someone. But it just kind of depends on what your individual situation is. So really the thing some of the things on the bottom here, the tax firm, the valuation firm, those are relationships you're going to have with an external firm. Whether you hire internally or not, that's kind of where you have to do the trade-offs, right? The cost of hiring internally, the risk of hiring internally, versus obviously the benefit of that person really spending 40 plus hours a week, and having a fully dedicated resource to the company. An integrated financial services firm like Early Growth can provide these services, and they can provide them on an as-needed basis. And I think that most of our clients are pretty surprised, pleasantly surprised at the value that they get, and the amount of service and the amount of support and the amount of expertise that is brought into the fold for the amount of money that they're spending. And so, early on, I would absolutely encourage you to look at firms like Early Growth, and there are others. So I'm not suggesting, well, I am suggesting Early Growth, of course, but you should definitely be interviewing other firms. Like I said, I think, it's not even just about the firm, it's about the individual, especially at the CFO level, and making sure that there's a good fit between the way that the CFO thinks and communicates and his expertise is and his network to what you're trying to do. So that's probably more important even than just the firm that you are hiring. But these are some of the things that you need to be thinking about. And in most cases, at an early stage or at a small stage, you're probably going to be hiring an external firm as opposed to hiring internally.
Okay, yeah.
When do you hire? When do you hire internally? You hire internally when you realize, hey, you know what, boy, the amount of services that I need from these guys is growing. The cost, because we and many other firms like us, we bill by the hour, right? So obviously on an hourly basis, we're probably going to cost a little bit more than if you hire someone internally. But if you hire someone internally, you're paying them a salary in most cases, right? So it's a fixed cost. Whereas us, if you need us for 2 hours a month, we come in for 2 hours a month. If you need us for 15 hours a month, we come in for 15 hours a month. At some point, obviously, if it's getting to be 30, 40 hours a month, it probably starts making sense. You're probably growing to the level where it starts making sense for you to be thinking about hiring someone internally. And we help companies do that, and we encourage companies to do that. So we lose 100% of our clients because hopefully they grow out of the need of our services. And we're thrilled when companies are in the position to actually have to fire us. Okay, so we kind of talked about all that stuff, and some of you are probably saying, okay, well, that's all well and good, Cirque, but I'm not so sure we have the wherewithal, or I'm not so sure the need, or this isn't the priority for me right now. I want to focus. Well, first of all, priority-wise, that's another thing that hiring a firm like ours. The nice thing is that it's not something where you're taking a huge long-term risk. So that's kind of the nice thing. But let's just even say that, hey, look, you know what? I'm kind of in product development mode, and I don't have external investors. I'm kind of bootstrapping, and I have a pretty good idea of what I'm spending, and for the time being, I just don't have a need for your services. So what can I do now prior to bringing on a firm like you guys or bringing on an expert like you guys? What can I do now? And that's a question that we get a lot. First question is, does it make sense for us to be hiring you? And in some cases, we'll say no, it's not. It's too early. You need to be focused on other things, and you don't need to be incurring the expense of hiring someone like us, as even as little as it is. And so what can we do now? So these are some of the things that you can and absolutely should be doing. Let's kind of start with points 2 and 3. You open up a business account, get a business credit card that is solely dedicated to your business. You have to separate your business expenses from your personal expenses. And it's not just about accounting. Yes, obviously it makes it difficult to account if we commingle funds, but there's a bigger reason and more important reason, and that has to do with liability. So basically, the reason why most companies set up companies, and when they set up companies, they set it up as a corporation or or an LLC, like a limited liability corporation or an S corp, something that separates the liability or limits the liability to the services of the company and what the company does, right? And that's why you set up a corporation. So that if the company gets into trouble, and you as the CEO or founder of a company gets into trouble for what the company does, then then someone could sue the company, but that's it, right? They can't come after you directly. If you commingle funds, if basically you are paying for business expenses out of your personal checking account, and if you're using your personal credit card to purchase things or services for the business, then at some point in time, someone could come in and say, hey, look, going back, it was very, very clear that you were the business, right? That you personally were the business, even though you had a separate company set up. That they might make the argument, that you are one and the same. And if they have a lawsuit against the company, then they can, go after you personally. And obviously, this is something that we want to limit or completely eliminate the possibility of. So for those two reasons, you need to keep your activity segregated. Set up a simple accounting system, and this, it's, to me, it's not rocket science. A lot of companies I know, or a lot of people I know, they kind of start tracking things on Excel, and they're only looking at kind of, what the credit card statement. They download the credit card statement, and they download their checking account statement, and use that to, as kind of record keeping. But set up a simple accounting system. You can go to, there's things like QuickBooks Online, which is run by Intuit, which is a SaaS model. There's even simpler ones like Xero, Xero, that's becoming more and more popular. These are services that cost, $25 to $30 a month, and it's so critical that you just kind of set this up. And all of these guys, what they'll do is they'll actually set up. You could go in and you could get started immediately with a chart of accounts. So you just, they'll do a quick interview with you, talk about the kind of company you have, and basically have a standard chart of accounts to start with. And you can just start entering data. And you could, learn to do it yourself, or you could have a friend or a family member who's, somewhat knowledgeable with, this kind of software. And it's not that much more difficult than Quicken. Right? So it's something that most people can at least start to enter transactions for. Keep it simple. These accounting systems, both Xero and QuickBooks Online, will grow with you for a long time. So don't feel like, hey, I'm going to do this, but I'm only doing it, and then what happens when I grow out of it and I need to change this? It's going to cause a problem. That's way down the line. You don't have to worry about that at this point in time. And obviously the last one, and this is one where, even if you're doing it on Excel, you should be keeping track of this, but understand what your expenses are, understanding what your cash burn is, always know when your cash out date is. Meaning that if let's say you put in $100,000 of your own cash, and you're not even paying yourself, and you're kind of starting on your own, and you're using a contractor to help with to help put together a web page, and you're trying to actually get people to log on. Well, there's still costs, right? There's costs for the development, there's costs for web page, there's costs for the server space, and so all those costs, even at the very early stages, you need to know what those costs are. You need to know how long your cash is going to last, because that obviously is the number one thing. So those are some of the things that I think you can do even at absolute beginning stages. In terms of tracking, and I apologize if much of our audience is already past this point, but we do get this question from kind of the first time or the very early entrepreneur who says, hey, whoa, I'm not ready for any of that stuff. I just want to make sure that I'm not really digging myself a hole here. What can I do? And these are some of the things that you can and should be doing. And I think that's the information that we wanted to present. I think the timing worked out well. We've got a few minutes. If anyone has any questions, then we'd be happy to take them on at this point.
We have one question that says, there are many startups out there in the very early stages for whom it doesn't make sense to hire a CFO. They're either just too small and it's not the right time. For startups like this, what advice can you give for properly managing finances right now and building the right financial foundation? Any words of wisdom?
Yeah, I think we kind of touched upon that just now. I'd say when we say early stages, I think that probably means several things to me. That says to me, okay, is a company or is a founder who is thinking about a company or has started a company, is doing some product development, maybe is doing some marketing research, has put in some amount of money on his own, whether by some cash that they've already had, or they may be taking on debt, they may be taking credit card loans, they may have borrowed some money from friends and family and put it in. And so at that early stage, you're probably right. It doesn't make sense to be hiring externally. Like I said, I think what you need to be doing is just setting, getting your ducks in order, getting kind of the infrastructure set up, set up a separate bank account, get a separate corporate business card, make sure that you are on top of your compliance issues. So it's the business registrations, it's the filing of your Delaware C corp. If you're a C corp, you should be setting up your corporation as a Delaware C corp, and making sure that you are registering yourself with Delaware. Obviously paying the franchise tax fee and making sure that you're legit. Register in the state that you're doing business. Get your FEIN, or your Federal Employee Identification Number, which is basically a company's social security number for all intents and purposes. It's your taxpayer ID. Get that registered with the IRS, so you've got an FEIN. You're going to need that obviously to open up bank accounts and things of that nature. Make sure that you understand your compliance and your tax filing timeline. That's important, because that's the one area where people they stick their head in their sand, because it's so painful to them. But understanding when the filings are due, and again, engaging at an absolute minimum, engaging with a tax firm who will do your taxes. Don't try to do taxes on your own. Even if it's a very, very simple return, you can have an annual return to the IRS and to the state that you're doing business in. And in many cases, you can get that done for hundreds of dollars. You have to do that. Don't try to do it on your own unless you are experienced with doing tax returns. Find a firm to do that for you. But understanding when those requirements are and not missing those. Do things like, if you are, understand, do research, things like 1099s. 1099s are forms that you have to fill out and give to any contractors, individual contractors that you've used, where you've paid them more than $600 in a given calendar year. You have to file that. You have to send them a 1099, and then you have to file that with the IRS. And failure to do so could cause you a lot of grief and a lot of pain, both in terms of stress as well as money. So, understanding some of those compliance things are probably an absolute minimum. That's what I would say. I mean, like, I know you don't want to be thinking about some of these things, and I'm not suggesting you spend a lot of time thinking about it, but just the bare minimums are key. And setting things up initially correctly will save you a lot in the long run. Think about the kind of business that you want to have. Is it going to be an S corp? Is it going to be a limited liability corporation, or is it going to be a C corp? Do some research to figure out what the differences are, and which one makes sense for you. Most startups that we work with, at some point they're going to be going to the public markets or the private markets for equity financing. And if you know that that's in your plan, you have to set up as a Delaware C corp. No sense in setting yourself up as an S corp or an LLC at this point in time. If you have a company where you're not going to be going for outside investors, you can do it cheaper by setting up an S corp or an LLC, and that might make sense for you. But again, kind of understanding, what your options are, understanding what the differences are in the different types of companies and corporations, entities that are out there, and making the right decision on the front end will save you, because it's painful to go from an S corp to a C corp. You have to file double tax returns. You have to close out the S corp. You have to start the C corp fresh. You don't want to go through that if at all possible. Don't try to save yourself a couple $100 in the initial stages by filing as an S corp, because the pain in actually converting from an S corp to a C corp, you don't want to go through that. So those are some of the things that I would say that you should be thinking about.
Awesome. Thank you so much, Cirque. And in fact, we had someone pop in and say how much they're enjoying this presentation. And we just had another gentleman that said, no questions right now. This was very helpful. I look forward to the presentation deck and the recording. And yes, that will go out to all of you tomorrow. So be sure to look for an email. In the meantime, thank you all for joining us for today's webinar. We very much appreciate your time and hope that you found it useful. If you have any questions, or if you think it might be time for you to hire a startup CFO and are interested in hearing more about how early growth financial services can support your company, please feel free to visit our website and fill out the Contact Us form for a free 30-minute consultation. We'd love to hear more about your companies and hopefully help all of you. If you're interested, our next webinar is scheduled for January 21st. It's tax strategies for 1099 independent contractors. Please feel free to join us for this hour-long free webinar with Derek Davis from Shared Economy CPA for this discussion around how independent contractors can maximize their tax benefits. And again, if you're interested in this or any other webinar, please feel free to check out our events page at earlygrowthfinancialservices.com. You can register there for any upcoming event and to see a listing of all other webinars we have to offer. We hope to connect with all of you again soon. And thank you again, Cirque, for an amazing presentation, and hope all of you have a great day.
Thank you very much, Gina, and thank all of you for attending. This was a lot of fun, and I hope to hear from you in the future.
And as well, and again, you can hashtag hire CFO should you have any questions. Thank you all. Have a great day.
Bye, everyone.